This meeting is being recorded.
Okay, it's official. This meeting
click on
is
got it
recorded.
versus leave meeting. I've done that before. Got it. You have a window
Oh,
that
yeah.
got it being recorded, hit got it.
Yes.
It's not good when you're a host and you knock yourself out of the meeting.
Okay, well, let's go ahead and kick it off for time's sake. We still got a lot of folks joining us, so at the end, we'll be able to see who got closest to the number of participants that they guessed. Welcome, I am Sarah Eleanor. I'm the Senior Manager of Homeownership Programs here at TSAHC. I have been here for just over 10 years. And with me today, I have our Director of Single Family Programs, Janielle Levesque. Do you want to wave, Janielle? And then we have our Single Family Program Specialist / expert, Frank Duplashan.
Howdy.
And then we also have a great partner with us, John Hudson. He's up in the right-hand corner on my screen, but he's a partner of ours that helps brokers access our programs. So any brokers on the call, thank you for joining. If you're interested in signing up, John's here with us today to get you started. So today we're going to cover our Mortgage Credit Certificate program. We'll discuss ways an MCC can increase your business, your referrals, and take your closing to the next step. We decided to host this training because we got a lot of questions the last live training that we did about the MCC, and it was apparent that there's a lot of interest in how this program works, and we really do want folks to completely understand and feel comfortable with it. And so we decided we'd go ahead and host a training for lenders and realtors so that you guys can learn about how to offer this program to first-time home buyers. We will, we do also want to note that this webinar is for informational purposes only. We are not tax preparers. We can't provide tax advice. We do, promote the use of a tax professional or CPA when using the MCC if they would like to talk about their specific situation. So we do want to put that note out there, a disclaimer up front. And then finally, we do ask that you try to hold your questions to the end. We will dedicate the last 20 minutes or so, 15, 20 minutes to a Q&A session for everyone. We will basically, if you want to put your questions in the chat feature at the end, or if you'd like to just unmute yourself and ask the question, I prefer that you unmute yourself and ask the question so that everyone in the audience can hear the question and the answer. I think that that's helpful because sometimes people don't even realize that they have a question until they hear someone else ask it. And furthermore, this training, as I stated, it will be recorded for future viewing, and it can also be shared with anyone that wasn't able to attend today. We will be placing it on our website to live in perpetuity until we do another live training or need to make any updates. So first of all, thank you for joining. And let's get started. So what are we going to cover today? We still got people coming in. We're getting close to 400. For those of you just joining, thank you for attending. We're already getting started. So what we'll cover today, we're going to talk a little bit about what TSAHC, who we are, what is an MCC, what is a mortgage credit certificate, how does it work, how is the benefit realized by the borrower? How the lender can use the MCC to help the borrower qualify for the mortgage loan. We'll talk about recapture tax, program fees, and how somebody would qualify. Okay, we got lots more joining. I'll be kind of bouncing back and forth, allowing folks into the training as I speak, so I apologize. So for those of you that have never heard of TSAHC, we are the Texas State Affordable Housing Corporation, and we were created by the state legislature to help serve the housing needs of underserved populations. And we do that with this concept of build, buy, and stay. So we help developers build and rehabilitate both multifamily and single-family affordable housing throughout the state. We help homebuyers buy their homes through our homeownership programs, and the MCC is part of that component. And then we help home buyers stay in their homes because we bring in training for organizations that are providing home buyer education, credit counseling, financial education. We also require home buyer education of anyone that plans to use our down payment assistance and or mortgage credit certificate programs, because we want to make sure that we are creating successful homeowners. We want them to stay in their homes. So we're going to take a deep dive into the mortgage credit certificate program today. We created this logo, and I like to show it because it is something that you can use on your social media accounts if you're wanting to promote this. And it does kind of give you an idea of what it is. It's your first home tax credit. So what it is a 20% credit on your annual income tax return, allowing you to get 20% of the mortgage interest that you spend on your mortgage every year back through this income tax credit. So it allows you to get 20% of that back. Still more people coming in, guys. You do have to occupy the home as your primary residence. You have to be a first-time home buyer. The definition of a first-time home buyer is anyone who hasn't had ownership interest in a primary residence in the last 3 years. So no ownership interest in a primary residence in the last 3 years is the definition of a first-time home buyer. The great thing about this is that if they are a veteran or if they are purchasing a home in a targeted area, which is considered a economically distressed area of the state, then that first-time home buyer requirement is waived. So if you, if you have a group of veterans that you work with or, clientele, then just know that they can always use the MCC. Targeted areas, we do have a lot of resources on our website to help you determine if a home is in a targeted area, should you have somebody that you know would benefit from this program, but they're not a first-time home buyer. You can always check to see if the property is in a targeted area, as that would waive that requirement. The powerful thing about the MCC, and what I want you all to get excited about, is that 20% credit that they get with the MCC, it's 20% of the mortgage interest, that can be used to help the lender qualify the home buyer for the mortgage. Essentially, that 20%, whatever that equates to, can be added to their overall income to help them qualify for the mortgage loan. So that can help with debt to income ratio issues. That can help increase their buying power. Now at the bottom here, we see—
I have a question. Sorry.
Yes.
So you're saying that they have to have one or the other. They can either be in an underserved area or whatnot, or their income, or they can not have had homeowner interest in primary home ownership in the last 3 years. It can be one of those, or it has to be all of them.
One or the other.
Okay, awesome. Thank you.
Yep. And it is free for Texas Heroes that are wanting to use our down payment assistance program. So if they want to use both at the same time, they don't have to pay the $500 issuance fee that is attached to the MCC program. Now we're going to get into a lot of details. We're going to do some math together. I'm going to make sure that you completely understand how this works. So, bear with me. First, I want to tell you the difference between a tax credit and a tax deduction. A tax credit is reducing their taxes owed dollar for dollar. And a tax deduction is a reduction of their taxable income. So those are two different things, and they're able to do both with a mortgage credit certificate. The tax credit is reducing dollar for dollar what they owe in taxes after their deductions. So let's say they have a $50,000 income with a $10,000 deduction. That means they're only going to owe taxes on $40,000 worth of income versus $50,000 of income. Obviously, they're going to owe less in income taxes on $40,000 versus $50,000. So they get their tax deduction, they go down to $40,000 in this example. Whatever they owe in income tax based on their tax bracket, etc., that is what the credit comes off of. So they're able to do both. It's not letting me go to the next slide. There we go. So how does this work? We gave you an example of a loan amount of $260,000. Still got folks coming in. With an interest rate of 6.875. The interest that they would pay in that first full year of living in the home, the first full 12 months of living in the home, is $17,875. So the MCC allows them to get 20% of that back when they file their income tax return. So 20% of $17,875 is $3,500, around $3,500, $3,575. We used to have a cap, and now we don't. So whatever 20% equates to is what their credit will be. Now, this is kind of how we're going to dive in a little deeper. And what we've been promoting is that in an interest rate environment that we're like what we're seeing now, higher interest rate environment than what we're used to or have seen in the past few years, the MCC can effectively lower their interest rate from 6.875 to 5.5 because they're essentially getting 20% of that interest back. And on the next slide, I'm going to go into even more detail on what that effective rate means. But this $3,575 is what the lender can use as additional income on their loan application to help them qualify for the mortgage.
Sarah, can I ask a question?
Yes.
I didn't know if, I know you said you prefer we take ourselves off mute, but I didn't know if you wanted us to ask questions at the end or like kind of.
At the end would be preferred, but if it's
okay.
like, you know, if it's on this slide in particular and you need clarification, I would be happy to answer.
So I thought I read somewhere where the IRS caps the MCC credit at $2,000, but is that only if you're applying it as a tax credit, whereas if you're utilizing as an income, that cap doesn't apply?
The cap does not apply if the credit rate is below 40%. Like, so if the credit rate is 20% on the MCC, which is what our credit rate is, there's no cap.
Okay, perfect. Thank you.
Yep. Okay, so we're going to go on the next slide, and this is kind of where we're going to go over another example so that you understand what the effective rate means and how you can, you know, potentially promote that to get people interested in using the MCC. So I gave you this example. Our rates change daily. When I made this slide, I don't know what our rate is this morning. I should have checked, but when I made this slide, the rate with an FHA, USDA, or VA loan using our 5% down payment assistance is 7.125. When you add an MCC, you're effectively lowering the rate to 5.7. And how you would figure that out, the math is 7.125 times 80% times 0.80, and that equals 5.7. So that is essentially what their rate, effective rate would be. But here's where we want to make sure that you are understanding what we're saying by effective rate. Your borrower is still qualifying for the mortgage loan based on the 7.125% in this example. Still qualifying for the mortgage loan at that higher rate. Their monthly payment will still be based on the 7.125 rate. However, they're getting 20% of that mortgage interest back when they file their income tax return every single year they live in that house as their primary residence. So it is very impactful in this higher interest rate environment that we're seeing to add an MCC on any loan that you might be offering the client. It doesn't even have to be a down payment assistance loan. It can be a regular loan that you're offering the client at market rate. but they're still going to get 20% of that interest back by adding the MCC. So you can use the MCC in conjunction with our non-bond DPA, or you can use the MCC by itself to still help the client get that mortgage interest money back. We're still getting folks joining. So now I'm going to go through another example. And this example we created, actually Janielle created when she first started here. And it's, I always say it's funny, like it's cheesy, but it's effective. So it's for those folks that don't necessarily like math equations, but need to see it more in a visual way. So we're showing you an example of, let's say her name is Sally, and Sally has an annual tax bill or tax liability of $10,000. That's what her taxes are based on her income and her income tax bracket. So she meets with her employer to set up her payroll income tax withholding according to her situation. And she wants a portion of her paycheck to be set aside every time she gets paid. So every time she gets paid, she's going to put a portion of that money into this empty bucket. And hopefully by the time she files her income tax return, she will have filled it completely with the $10,000 she needs or owes the government. In this particular example, she more than paid what she owed. Some of that money spilled out. And so therefore she's going to get a refund because she more than paid the government what she owed. And so the government's giving her her own money back. We show this example because a lot of times folks think that because their borrower already gets a refund, they're not going to benefit from the MCC. And we show you this example because that's not true. She just set too much aside, and so she's getting some of that money back. And so we want to show you how an MCC can impact that. So the little MCC man, this is the cheesy part, but also cute. So she's starting off the year with the same tax liability, the $10,000, empty bucket. The MCC man goes in first. And in this particular example, the MCC amount was $2,300. And so her remaining tax liability is $7,700. She's going to keep everything the same with her employer so that she's having the same amount set aside every time she gets paid. And this year, obviously, more money is going to fall out or overflow because she started the year off with a fuller bucket than she did the year before. And so her refund is actually going to increase by exactly the $2,300 of the MCC. So just because your borrower gets a refund doesn't mean that they won't benefit from the MCC. If they have a tax liability, they will likely benefit from the MCC. And I'm going to talk even more about that in a few slides. I did want to show you, though, that we do have a mortgage credit certificate calculator on our website. And this is something where you can type in your sales price and your interest rate, and it will automatically calculate your MCC tax savings. So you can see what that first year will be, how much they'll save cumulatively in year 5, cumulatively in year 10 and 30, and so on. So basically, right here, we're showing you with an example of $260,000 at a 6.875. The interest they'd save over that 30-year period in their home is $70,977. That is a huge amount of money that they could be putting toward all kinds of things, retirement, college, savings in general. So this is an easy way for you to do the math if you're looking for a way to show the benefits to your clients. All right, every time I click to let people in, I lose my ability to go to the next slide. So we do have this MCC calculator on our website. You can take a screenshot or you can take a picture of the web address at the bottom of the screen if you would like. Let me let a few more people in here. Okay. So as we discussed, all homeowners can take deductions, but tax credits are only available to a holder of an MCC. You do have to apply for an MCC before you close on the loan. It's not something that can be applied for retroactively. So you want to make sure that if this is something that would benefit your client, that they apply for it before they close. Also, they are able to take both the credit and the deduction, but should you have some self-employed borrowers that itemize their deductions, they can still do both, but in this example, we just show you that essentially they would be taking their overall deductions minus the credit, and that's what they would be able to take as their credit, if that makes sense, or as their deduction, rather, their mortgage interest tax deduction. It's also the home buyer's responsibility to make sure that they file for their mortgage income tax credit every year. And so, ideally they would again consult a tax professional when they're deciding on how to take the credit. Some folks like to adjust their withholding so that less money is being taken out, knowing the credit is coming to them at the end of the year. We always tell folks to please talk to a tax professional in that situation, because you're never going to be able to adjust your withholding so that the exact amount of the credit is being added back to your paycheck, if that makes sense, or not withheld from your paycheck. And so you don't want to get stuck at the end of the year with a tax bill that you weren't expecting because you had not enough taken out of your paycheck throughout the year and the credit didn't cover it all, didn't cover your liability at the end of the year. So you just want to make sure that, hey, if I adjust my withholding from 0 to 1 or 1 to 0, whatever that looks like, you would have a tax professional tell you exactly how that impacts your paycheck every time you get paid. When you file for the tax credit, there is a special form. It's called the 8396 form. So if they are having someone file their taxes, paper taxes, then that's the form they would complete. Any online tax prep service will likely ask them about whether or not they got an MCC, and it will ask them for the information located on the actual mortgage credit certificate. It's an actual certificate, paper certificate that we send them in the mail. And it will ask them the questions that are on the 8396 form. Now, if for the realtors on the call, for the lenders on the call, this is where I always remind you that tax time is the same time every year. If you help somebody use this program, just put a little reminder on your Outlook calendar or on your phone calendar. Remind so-and-so not to forget to take their MCC credit this year. And I know that you all are always looking for ways to stay in touch with folks that you've helped in the past. This is a great way to do that. So just remind yourself to go ahead and reach out to those folks that you've helped in the past year, or in the past in general. Okay, I talked about the W-4. And I talked about that it can be complicated adjusting your withholding because it's never exactly the amount of monthly income the MCC would provide. So tax professional, as we mentioned in the beginning, we'll just keep saying that. And the MCC is a non-refundable credit. So this is basically saying if you have a home buyer that does not have a tax liability, meaning they don't pay income taxes, maybe it's social security disability, they don't pay income taxes on that money, then the MCC is not going to be of value to them because there's no liability to reduce, if that makes sense. However, if you are working with someone that won't benefit from it in the first year or the second year or the third year even, any unused credit can be rolled over for up to 3 years. So I always tell folks, if you've got people that you're working with that, I always use the example of a young couple where one person's in school and the other's working. Their tax liability is going to be pretty low in the first year or two. And, the next year they both are working because the one graduates from school and they get a really great paying job. Their tax liability is going to go up. And most folks have the goal of making more money as they grow in their careers. And so don't not apply for the MCC just because they're not going to benefit from it fully in the first year, 2, or even 3. Because the only time you can apply for the MCC is before you close. So if there will be future benefit by using the MCC, then they should apply for it. Oh, and then the third bullet point here, the credit does not reduce what a home buyer pays on their mortgage. It reduces their federal income tax liability owed after standard deductions and all other credits. Okay, so this really has nothing to do with their mortgage other than the fact that the lender can use that income to help them qualify upfront. This is kind of the same example that I was just talking about, and how, let's say their current tax liability is $2,500 and their current year mortgage interest tax credit is $3,575. That means that they're not able to use the full $3,575 of credit that year. So they're left with $1,075 in unused MCC credit. And then next year, let's say their income tax liability goes up to $5,000 and they're able to use the full current year credit of $3,575, and their balance is now $1,425. And then they can pull from last year's credit of the $1,075, and then that basically leaves them with a $350 tax bill. I know math is not fun to look at, but we're just trying to show you that the credit's only going to reduce what's there. And this is an example of how they can use unused tax credit in the following 3 years if needed. It is allowable by the lender to use the MCC amount to qualify them for the mortgage, as stated previously multiple times. And if the home buyer's tax liability allows, you can add the credit into their income. So I showed you an example of that on one slide. And this is how you would figure this out. So you would take the mortgage amount times the note rate times the credit rate of 20% and divide that by 12. And that's how you get the additional monthly income that a lender can use to qualify this person for the loan. So $3,575 divided by 12 equals $297 that can be added to their monthly income. So I think this is the same kind of example of unused mortgage credit amount that can be rolled over for 3 years. But in this example, we're wanting to show you that if a lender is planning to use the MCC credit to qualify them for the mortgage, then they need to ensure that their tax liability is equal to or greater the MCC credit amount. So in this example, this person's tax liability is only $3,075, but the MCC credit amount, which is the 20% of the mortgage interest spent overall, is $3,575. So they're not able to use the $3,575 to add it to their income. So instead, they're only able to use the $3,075, which is their liability, divided by 12. So it kind of reduces the amount that they're able to add to their income for qualification purposes. So only 200.
I'm sorry to interrupt. Can you show us that slide again before, where you were calculating the amount that there would be credited to their income? I apologize. Yes.
Mortgage amount times the note rate times 20%. So 20% of the overall interest spent in that year is $3,575 in this example. So $3,575 divided by 12 months in the year, 12 months in the year, equals $297 of monthly income that the lender can add for qualification purposes.
Thank you.
You're welcome. So the next slide we're showing you is that it is helpful for the lender to determine what their tax liability is to ensure that they are going to be able to take the full MCC credit amount. And so we wanted to show you an example of what it might look like if their tax liability is lower than their credit amount. Then the lender would have to take the tax liability divided by 12 versus the credit amount, because the credit amount can't be larger than their tax liability. So in this example, they're only able to add $256 to their monthly income instead of the full $297, which was the $35.75 divided by 12. So some reminders. The MCC credit amount can only be added to their income. It cannot be used to reduce their principal, interest, taxes, and insurance payment. And that's unfortunate. I mean, it does help still, but it just helps a little less than it would be if we were to be able to reduce the PITI payments. But know that you can still use it as additional income. Again, be sure to only add the correct amount of the credit as income based on liability and taxes owed, which is what we just showed you on the previous couple of slides. If using an MCC as loan application income, you don't have to count that toward their household income when determining if they meet our income limits. So the credit itself is not going to disqualify them from the benefit of the MCC. So you can use it to help them qualify for the loan, but you don't have to include it when you're determining if they meet our income limits. You are not required to use an MCC credit as loan application income if you don't need it. So if you don't need that extra income for loan application criteria qualification, you don't have to use it, but you can. Okay, so fees, pretty standard. We charge the $500 for the issuance fee, $200 compliance review fee. When you're combining it with our non-bond DPA, then the $500 issuance fee is waived for Texas Heroes, but is still charged on every other file. So the same $700 is charged. There's a couple of nuances there as far as payment. Typically on a standalone MCC, this is handled by the title company, and they would pay those fees directly to TSAHC via check or ACH. And then when combined with our DPA, then there's no fees sent to TSAHC. It's all handled by title as well, but it's deducted from the loan purchase. So our investor will purchase that loan from the mortgage company, and it's all handled at that time. So now we do have to talk a little bit about recapture tax. So recapture tax is very rare. And I keep telling myself I'm gonna look up this study that they did in Iowa, and Jonielle, you've got to hold me accountable for this. But there was a study done in Iowa about the MCC program, and they looked back at all the folks that had received an MCC, and they wanted to see how many of those folks were actually affected by recapture tax. And the percentage was less than 1%, less than 2%. So, and I don't remember how many years they looked at, but like basically I want to say from the beginning of time to present, which was, a 3 years ago when they did the study. So it's very, very low, the percentage of people that are affected by this, but we have to teach you about it. So the first thing, and it's all three of these things or nothing. So the first thing is they sell the home within 9 years. They make a net profit on the sale after everyone involved has been paid, including the realtors. And then their income limit, or their income has to increase by 5% above and beyond the income limits for their particular county at the time of purchase every year they live in that house. The third one is the one that typically doesn't happen, and therefore people are not subject to recapture. So I always give the example of, let's say you're helping someone use this program that was making $80,000 when they moved in, but the income limit for their county was 110. It's 5% above and beyond the 110 every year that their income would have to go up. Oh, so 5% above and beyond the 110 every year that they live in that house, and not 5% above and beyond the 80 that they were making when they moved in. So that one is typically what doesn't happen with the clients that use our programs typically. But if all three of these happen, then they would be subject to recapture tax. And we do have a lot of information on that on our website. It's likely not going to equate to be the full benefit that they've received from the MCC, over the time that they had it. But it's a percentage based on what year they sell. Okay, so how does somebody qualify? We have our Home Sweet Texas program, which is for anyone in the state of Texas. And then we have our Homes for Texas Heroes category. And really, the only difference is that the heroes get the free MCC if they combine it with our DPA. Otherwise, the same benefits are available to anyone in Texas that meets our income limits. The Texas Hero category, the main benefit that provides you, lenders and realtors on the call, is that you can use these target audiences to market yourself to. So if you want to market the program to these particular audiences because the state of Texas has a program for them, then that's really another benefit that you could see for the Texas Hero category. So we do have income limits. It's based on household size. It's based on county. We do consider household income when using the MCC. And so household income is anyone that will end up on the deed of trust. So only those that will have ownership interest. And all spouses' income has to be included regardless of whether they are on the deed or legally separated, because that is, we live in Texas. We are a community property state. The MCC income can be different from loan qualification income. Keep in mind, if you plan to use the MCC credit amount to help them qualify, you don't have to include it, as I stated before, to determine if they meet our income limits. And we have an appendix section in our guidelines that goes over. Yes,
hold on.
I think that was probably a mishap. The appendix section of our guidelines goes into all kinds of scenarios about how to income qualify someone for the MCC program. If you've got self-employed borrowers, if you're questioning whether or not to include, what do I want to say, car stipends or housing stipends, et cetera. There's all kinds of scenarios that are walked through in that section. And then we have our income and purchase price limit chart. And I was going to help you walk through that. We have some areas highlighted for to draw your eye to. So the counties and area is the first thing that you'll want to find. And the one that's most overlooked is the very first one. And that's the one that is in balance of state. So basically any county that you don't see specifically listed on the chart would fall under this very first row. So we get the question a lot. I don't see El Paso County on the chart. I don't see whatever other county. And so then we'll say, well, look at the very first row. It falls under that row. So you read across accordingly. You'd say, okay, I've got a household of 1 or 2. I've got a household of 3 or more. And then if you have targeted area, home, then you would look at the dark blue column, which targeted areas allow your borrower to make more money and still qualify for the program. And then we also have purchase price limits all the way to the right. So we've got our non-targeted area purchase price limits and our targeted area purchase price limits. The targeted areas, again, offer a higher purchase price limit. than the non-targeted area. So if they meet all that criteria, then it sounds like you've got someone that can use the MCC.
I'm sorry to interrupt you, Sarah. I got a good question. I don't think I've ever heard this one. It's a great question. Just for the class, what causes a county to fall under all counties not specifically listed? Is it based on population? Can you elaborate on that? Do you know why they fall there? Because I don't know.
So it's a very complex calculation that's given to us by HUD. And essentially they give us a balance of state number, and any county that falls above the balance of state. So basically if the income limit for that particular county is higher than the balance of state income limit, then we call that county out specifically. Same goes with purchase price limits. So you may see where we have a county called out that has the same income limit as the balance of state, but for whatever reason, they have a higher purchase price limit than the balance of state. And sometimes it's both. So that's why it's just a calculation that's given to us by HUD. And so we call out the counties that have higher limits. And there are actually some rules out there that say that higher cost areas can have a little bit higher income limit as well. And so we call those out as well.
Thank you.
Hope that answers you. Yeah, absolutely. Okay, underwriting and credit score requirements. We don't have a minimum credit score requirement on the MCC. So if you're planning on using that by itself, no minimum credit score required. And they can add it to any kind of fixed interest rate mortgage that they want. We don't even really have a requirement on the term of the mortgage loan that it's attached to, as long as it's a fixed rate mortgage. They do have to complete a homebuyer education class before they close on the loan. We have a website called the Texas Financial Toolbox where they can search for a class in their area. In order to use the MCC, you do have to work with an approved participating lender. If you're on the call today and you're not already participating, if you're a broker, we've got John Hudson here with Mortgage Financial Services, who has a program in place to help brokers access our programs. If you are working for a mortgage company or a bank and you would like to get your company signed up, Frank's your guy. We have all the information there. But we do like to highlight participating lenders on our website. So we track production and we update these sections every quarter. So the statewide top performing loan officers are those folks that have helped the most Texas families in the last quarter. It's generally around the top 20 for the state. The second section remains the same throughout the year, and it's based on the previous year's production. So they helped the most families in 2022 use our program, and it's the top 3 per region of the state. So they're kind of like the local expert on the program. And then we have the third section, which is the preferred loan officers by county. These folks have helped at least 4 Texas families in the past 12 months use our program. We reach out to those that meet that threshold every quarter and ask if they'd like to list themselves in this section so that home buyers can find them there. So if you're a realtor on the call, this is where I would recommend you going to build those relationships with folks that really truly know our program and how it works. Under the home buyers and renters section, this is where you can find the eligibility quiz. So we talked about how does somebody qualify, but if you forget, that's okay. We have a quiz. It's 4 questions. You'll know in about, I would say probably, I don't know, less than a minute, 30, 45 seconds, whether or not the client that you're thinking about would qualify. And there's also even a little video that they can watch that shows them how they basically are just working with a lender to apply for our program. So they're going to the lender, or maybe they go to the realtor first, and then the realtor sends them to their preferred lender for TSAHC's programs. And that lender takes them from step 1 all the way to closing. There's no additional paperwork that they have to submit to us directly. They're just working with the lender to qualify for the mortgage, as well as our assistance. So lenders, I know we have a mixture of lenders and realtors on the call, so I like to show you that you each have your own section on our website. Lenders, you have a plethora of information. Today's interest rates, you have marketing materials. If you're interested in, starting to spread the word about the program, which we hope you will be after today's training. And then we also have a link for any reissued MCCs. And I should touch on that. If somebody uses the MCC program and they should refinance their mortgage, they don't have to get rid of the MCC. They just request a reissued MCC with us. So they get to keep their mortgage credit certificate even though they refinance their loan. And we have a special link for that. And then at realtors, same for you. You have similar information available to you, marketing resources, etc. We depend on y'all's partnerships to help us spread the word. There are really just Frank and I, and Danielle has also helped, she's moved into a little higher role within the organization. So, there's 2 or 3 of us for the whole state of Texas. So we depend on you guys to help us spread the word and get excited about these programs. So to get started, we just wrote out some steps, various steps, depending on your role. If you're a loan officer, you'd want to take our loan officer and underwriter training, which is module 1. If you're a processor or a closer, you take module 2, module 3 for shippers. If you know that you're working for a company that is already approved, then you would want to reach out to your program administrator. If you aren't sure who that is, then Frank can put you in touch with that person. And that's how you can get started. And then obviously we want you guys to go out and market and sell yourself using the MCC and its benefits. So show people that you can help them save money on their mortgage interest. You can help them with these rising rates that we're seeing. Think of creative messaging that you can put out there, especially on social media, because that seems to be where it's at these days. Okay, lenders. I'm pointing toward the lender training. So, if you're wanting to get started, you would go to the lenders tab again, click on lender training, and you'll see the required training modules there. We also have a lot of great material, optional material, supplemental material if you're wanting to learn more, short how-to videos on how to do certain tasks once you get up and running. Realtors, you also have realtor training here. If you're interested in learning more about our down payment assistance, then you can take our CE credit class. It's free, and you'll get 1 continuing education credit. It's called Overcoming the Down Payment Hurdle. And so you can look at that schedule to see if there's any times coming up. Most of them are via Zoom. Some of them are in person throughout the state. We've got optional trainings for you as well. Marketing resources, lots of stuff. Some of this is just examples on what you can order from us. These are all downloadable flyers that you can co-brand. So you can download them, co-brand them at the bottom, start handing out and spreading the word. 10 steps to buying a home. Folks like this a lot. We do have a Train the Trainer webinar. I would encourage anybody to take that, realtor or lender alike. It's going to teach you how to take this information and run with it, essentially. Become a TSAHC trainer and learn how to partner with other people to provide first-time homebuyer workshops, or provide a training to a group of realtors or a group of lenders or a group of housing counselors, or anybody else that you think would be beneficial to teach about these programs.
Sponsor teacher's lunch.
A teacher's lunch, yes, a lunch and learn. Let's see here, a couple of other things. I'm not going to go through all of these, but a cute idea at the bottom here, I thought, was that you could do a coffee takeover where you have a little bit of money and you give it to the cashier and you say, I'll pay for the next $100 worth of coffee, and you make somebody's day because they had their coffee paid for, and then hopefully you'll be able to give your little elevator pitch on how you can help somebody get into a home using these programs. Thought that was cute. Social media stuff, we do post a lot of blog material. So if you're not a blogger yourself, we do write a blog almost every week, and it somehow will always tie back into our homeownership programs, our down payment assistance, or the mortgage credit certificate program. And so you can share that, you know, if you're looking for content, you can share that content. Okay, so I think we've reached the end. I know that my director, Janielle, wanted to make a few closing remarks, so I will pass it to you before we open it up for Q&A.
Well, I wouldn't say closing. We're going to be around for another 20 minutes or
well,
so.
yes, but
I definitely wanted to get the
close the
going on questions. So, you know, as Sarah mentioned, I recently took a new position at TSAHC. I used to be the director of homeownership, which was helping Sarah and Frank get the word out. And I have since taken on our compliance department as well. So directing both compliance and our home ownership, which is more of our business development side of things. But I just wanted to mention to everyone that, you know, we've been making a lot of changes in our MCC department, which are good things. We are, you know, working on efficiencies and policies and just trying to make it as easy as possible for you to use an MCC for your home buyers. Just for those of you who don't know me, I was a mortgage lender for over 20 years and
broker.
I'm sorry?
A broker.
Yes, I was a mortgage broker. Exactly, John. Used to work with MFS. So, you know, I recognize how complicated the MCC program can seem to folks. And that because of that, you know, we tend not to promote things that we don't fully understand. But when looking back on my career as a mortgage broker, I realized how many first-time home buyers I really did not do a good service to by promoting the MCC program to them. And so I just want you guys to feel free to email us or contact our MCC department manager, who is Danetta, and ask questions about our guidelines, our processes, or any you know, maybe even a condition. Maybe you submit your first MCC file and there's a condition on that file that you just have questions about. We're working really, really hard again to reduce the overall complexity of the MCC program. Obviously, we can't do anything about waiving IRS requirements at a minimum, right? But we're working hard at making it easier otherwise. So I encourage all of you to use the MCC program for the first time. I do have a couple of things that I want to mention that I noticed a lot of the questions coming in that Frank and John, thank you, John, for helping with that. That's, you guys have had a lot of questions. But I noticed one of the things that came up a couple of times, and I want to clarify, you know, a lot of folks, I came up with that bucket idea because, you know, we do say that a home buyer cannot benefit from an MCC if they don't pay income taxes, right? And that means it's someone who's literally not paying income taxes. I think a big misunderstanding is that when people get a refund each year, they assume that that means they are not paying income taxes. So I created that bucket scenario to show folks that, yes, you are paying income taxes. You're paying income taxes through payroll deductions. It's not that you're paying at the end of the year at tax time. You're getting a refund, and you only get, you know, the word refund in and of itself means I'm getting some of my own money back. So that is an example to show you that most home buyers, you know, who even get refunds, they're paying income taxes into the system. And so they're just getting some of that in a refund back. And then in addition to that, this MCC tax credit helps the refund grow. So I just wanted to clarify that, because I think that is probably one of the biggest misconceptions out there, is that people assume that they're not paying income taxes because they don't have to write a check at the end of the year. In reality, you have prepaid those income taxes, right? So hope that helps clarify some of those questions for folks. And please welcome those questions now.
So let's go ahead and open it up for the Q&A. John?
Hello.
Hi.
Hey, Millie.
Hi, how are you, John? I'm going to carry over from my conversation with John yesterday. By the way, if you're not using MFS, you know, that's okay, because I bug John all the time. I get that if anyone in the household is retired and disabled and not employed in the future, like I have a veteran that is not getting income or not paying taxes, had 100%, no, he's 80% disability, but unemployment in the letter. So basically he's not filing for taxes, right? Typically when I add MCC is because I'm always using that additional income to help their ratios. But in this event, in this case, this person does not pay any taxes whatsoever. So even though the liability, like, let's just say that if I just have a sales price that I'm like borderline on the DTIs, can I add in this scenario MCC?
No, ma'am. You are essentially qualifying them on income that doesn't exist.
Got it.
Right? So if they cannot benefit from the MCC and utilize that credit,
There is no income. Okay.
then that you are using income that doesn't exist. And we actually will, you know, we do ask for 3 years tax returns really to prove the first time home buyer requirement, but we will look at and glance at, are they paying income taxes?
That is okay. Now it's fully in my brain. Thank you.
Yeah, no. I was just, you know, a pro tip for all originators out there. I would definitely look at the most recent tax return and consider it basically the same as you would be requesting to look at a pay stub for that borrower. On line 24 of page 2 of the tax return, it states right there what the borrower's total tax is. So if it says 0, I mean, in theory, yeah, the borrower can still get the MCC. They can still pay for it and get it. It would just be of no use until they have a tax liability. So you would not be able to use that income towards qualifying at that time. But we have seen instances where, yeah, in just that instance, borrower didn't have income this year, but they're projecting it for next year. So the MCC still made sense to give it to them because it'll help them in the future. So, but just note to self, get those tax returns and look at the very least, the most recent previous when you're getting ready to do that loan.
That's a good point.
So that's my little pro tip. But here, I got a softball for you guys though. What happens if my borrower filed the tax extension for 2022? Can they get the MCC?
I'm actually working on that as a
Really?
Well, okay, so no, they have to have filed their tax returns by the February 15th right now, based on our policy right now. But I am working with an attorney. I made the comment, you know, we're working on efficiencies and processes. I am working with an attorney to kind of go through all of our guidelines and make sure that we're conditioning at anything that is required IRS guidelines, right? And this is one of those. But I think that there may be some flexibilities there that we're looking into. So I can't give you any answers on that until I have a definite.
Okay,
But
I won't go.
right now they have to have at least filed, and we will take a signed tax return.
Yeah.
As yeah.
Yes.
Don't worry, I won't go start selling that yet.
Please don't. Please don't. I mean, I hope to have some flexibilities there, but there's no promises, you know. The part for me that I think is difficult is that, you know, the current IRS requirement is that they must have filed by February 15th, which most, you know, folks haven't, their taxes aren't due till April 15th. So it's kind of that little gray area there that is confusing, I think.
Yeah.
Another thing I just want to point out and just remind folks of on the mortgage credit certificate program, if you're doing a standalone MCC, right, you just slap that sucker on a normal loan, then it's your regular revenue per loan is coming through.
Yeah.
It's only on a down payment assistance portion where there would be some revenue restrictions on the loan. So for my broker partners out there, what does that mean? For a standalone MCC, it's your normal standard lender paid compensation, no adjustments to that. You know, I guess one of the other questions that I get too is, you know, at least on the broker side, is it sounds complicated and hard. is there a bunch of paperwork that needs to get filed? And I would just say, so the way that as a wholesale partner, we put it together is we kind of sell this as you catch it, we'll clean it and fry it. So we actually have a department that will handle all the registrations that has to be done with TSAHC on the back end. So we just want you guys to go out there and sell the product and help literally put money back in a consumer's pocket. So so that I think there is important. And just again, put my sales hat on, because yes, John Yellen, you'll find out it is possible to wear both compliance and sales hats at the same time.
Yes.
Selling talking to people about the effective rate is really important. I know that there's a lot of consumers that are sensitive out there right now. They hear, oh my gosh, the down payment assistance rate is 7.5%. That's too high. Well, if you use that calculator that's on TSAHC's website, I use it daily. Because you can do the math the long way, but the computer will just do it for you. Once you show them hey, look, here's how much the borrower's tax credit is going to be. We're taking the note rate and we're taking 20% off the top of that. Here's what the borrower is really actually paying. When you explain that and put that illustration out there, it'll help sink in. And feedback I've gotten from originators out there is that literally taking that calculator snapshot and then showing them the math where, hey, we took 20% off the top of that note rate. It's helped calm the nerves or nervousness that consumers might have. They're really not paying 7.5%. It's really going to be like 5.9. I mean, in that type of scenario. So if you've got questions about that effective rate, be more than happy to share my hot sports opinions on that too.
So I did see some questions on that, some chat questions came through, and John, maybe you can help clarify this, but they were talking about disclosing that rate and APR and all of that. And, from my understanding, that is not the actual mortgage rate. So there is no disclosure required.
Correct. Right. I mean, so when you're putting that out there, if you're disclosing the note rate, right, which you would have to, I mean, if you're actually delivering disclosures to a consumer, or even for advertising purposes, right, you're putting that on a flyer. I mean, you're going to have the note rate, your APR, but then down at the bottom, here's the effective interest rate. And again, I would just put the little asterisk mark. Please check with your attorneys and your compliance department. But in my hot sports opinion is no, that would not require an APR disclosure, because again, it's an effective rate. It's not the actual note rate.
Net rate might be one way of saying it. You're ultimately paying through your mortgage payments, but based on the refund of that 20%, your net rate that you paid was that effective rate.
Correct. Yeah.
Yeah, and like Janielle always explains, if you wanted to put a disclaimer at the bottom of a flyer, if this is what we're talking about, the disclaimer would say something like, you're qualifying for the mortgage at the note rate. Your monthly mortgage payment will be based on the note rate. We're just explaining that you will get 20% of that back when you file your income tax return every year. So there's no confusion.
One question I see here that's kind of interesting, it'd be good for you guys, is do you need 2 or 3 years tax returns? And just to put that out there is, what happens if 3 years ago my borrower was not required to file tax returns because they didn't have income, or they're new to the country or something like that?
Great question. So on our program affidavit that the borrower signs, there is an actual section that addresses just that. If the home buyer was not liable was not required to file a tax return, they can put a check mark on those years. That does not mean, did your borrower file a tax return or it's not based on whether or not they filed it. It's a matter of whether or not they were required to. So if they weren't required to file it, then obviously they have nothing to provide.
Perfect. That's a great answer. Yes, we've helped some folks with that.
Yeah. And that's a common mistake folks make, is they disqualify themselves thinking, I don't have 3 years tax returns.
Just to clarify a couple things, I got a couple questions just to clarify. For household income are going to be the people that actually own the house, the people that are going to be on the deed. So if you have older children in the home, we don't count their income if they're working. We just go off the people that will actually own the home. Same goes for an elderly parent. Got a question about that. And then as far as if they're already living in their home, unfortunately, if they already live in a home, it's too late to apply an MCC. They'd have to add it before they move into their home. I'm sorry, I had one other quick question. And to clarify, the February 15th tax requirement, you're only required to file taxes by February 15th to receive an MCC. Afterwards, you're not required to file by February 15th every year. I just wanted to clarify that. We had some confusion on that.
Good point.
Just the initial year.
Yeah,
Not every single
I
year.
liked how, I don't know who said this, but it kind of made me giggle, but it's basically like the MCC is very much a government program. So the government's not going to give you money without first knowing that you've paid your money to them. Of like, hey, have you paid your income taxes? Okay, we can give you an MCC. So that's kind of, I think that just made sense to me. It clicked.
Yeah, I say that about the income too, when we talk about household income. And, you know, people say, well, do I have to include bonus income and overtime income and my garage sale income? And, you know, ultimately the IRS knows exactly how much you make. So you're going to have to include all sources of income for anyone that has ownership interest. So IRS knows how much money you make. They're watching.
And
I have
just,
a question.
oh, go ahead. Go ahead, Kathy.
If I have a lender that's fixing to start working with a buyer that I have for the down payment assistance, will that lender automatically see if they're eligible for the MCC, or do they have to ask?
Unfortunately,
Okay.
I mean, you know, I always encourage home buyers and realtors alike to advocate for themselves. Of course, we would like every lender out there to promote and qualify for everyone for an MCC, but it's just like with anything else. You have to ask and make sure that your lender is qualifying you for an MCC. It's
I'll ask her about it because she's trying to do the down payment assistance.
Yes,
Okay.
absolutely. And, you know, as I mentioned earlier, I was a lender for 20 something years, and an MCC is a complicated thing. So I think a lot of lenders, you know, they've heard of an MCC, but they don't fully understand it. And so because they don't fully understand it, they're not promoting it. So help us educate our lenders on these programs by asking them to use these programs. And then they can contact Frank, and Frank will lead them in the direction of the right training they need.
So I would just like to add that I'm not good at asking for stuff. I like to tell people what to do. So you can choose to ask if you want, but I say, hey, give me an MCC. There's no asking. Got a couple quick questions. Do you have to take a first-time home buyer course for MCC? Yes. Even if you're just doing a standalone MCC, you still have to take one of the approved home buyer education courses. Verification of rent is no longer needed for the MCC program. We no longer require that. I'm sorry, there was one more. As far as the application process, a lender, for the realtors out there, a lender will actually submit a package to us. It's typically approved in about 2 to 3 business days. Just has a couple of documents that are required. We review them, give them approval to close, and that's it. 2 to 3 business days is our processing time. How long it takes your underwriter and your lender to get that into us is up to them. And then just one more thing. It was a good question. I'm sorry.
People who are on chat, because Frank is doing a really good job. For those of you who have submitted a chat question that Frank did not answer, please unmute and ask those now.
Yeah.
Hi, I had asked a question regarding, I have a buyer who has an investment property. It's not her primary residence, and until she sells it, she's planning on living in it. Would that disqualify her from the MCC?
Yeah, anyone who has had ownership interest in a primary residence in the last 3 years would not be considered a first-time home buyer. So if she's lived in it, if it's been considered her primary in the last 3 years, then that would be a disqualifier.
But the fact if she
unless she's a veteran or wanting to purchase a home in a targeted area.
But if she owned it and she didn't live in it, it was just an investment property, she'd be good, right?
Correct. Mm-hmm.
Okay, perfect. Thank you.
The MCC education, is it required if you are buying in a targeted area and you're not a first-time home buyer?
Yes, it's required on all files.
Okay.
Question regarding the lender only approved on your program and not MCC.
Sorry, can you say that one more time?
Not approved for MCC, only for the grant program.
Yeah, the lender does have to be approved for both programs. If you have a lender that you're wanting to work with who's currently working on our DPA program and is not with our MCC program, have them contact us and we will help them get started in the MCC program. I think that's what your question was, Karen. If you were going in and out, so hopefully we answered your question.
But can you see another, perhaps, if the company does not allow?
I'm sorry, Karen, it's really tough to hear you.
Okay.
I have to enter your question.
Maybe
I'll
try
email you. Email you.
Thank you.
All right, thank you.
Yes, is the train the trainer webinar information on the website?
Yes, ma'am. Good question. That one is listed under the trainings. Sarah, you want to go back to that slide or take them to the website to show them where all the trainings are? We have under the lenders and or realtors tab, you're going to see realtor training and or lender training. You click on that and there you will find required modules, which are for lenders. And then you will also find optional trainings. And Sarah, I think that one, the train the trainer is probably under optional trainings. Is that correct?
Correct. Mm-hmm.
Yeah. And the train the trainer is great for anyone who, you know, as Sarah mentioned, is looking for ways to market themselves and build a business around down payment assistance programs and mortgage credit certificate programs. And it also provides you slide decks and scripts and all kinds of marketing ideas on how to promote yourself. Any other questions?
Yes, I have a question concerning line number 24 on the tax return. So there should be money listed there, or no money should be listed there for line 24.
There should
be something listed.
There should be something there in order for them to benefit from the MCC.
Okay. Okay. Thank you.
Now, just to add to what John and Sarah were talking about as well, if there is a situation where there will never be taxes paid, then an MCC is not for them. But it could be, as Sarah gave an example, maybe the borrower is a college student right now, so they're not paying into the system. Or maybe they have so many other credits from childcare tax credits, or other credits that there's a zero there, but that situation will change for them in the future. You want to go ahead and get the MCC application, even if they can't use it in the first, second, or third year, because they'll be able to use it for the remainder of the 30-year mortgage.
Yeah,
I also had a question about. Go ahead,
Brian.
Yeah, when we talk about the taxes, I have a customer of mine who's also a good friend of mine, and recently did his taxes through TaxAct and owed $262 in taxes, then remembered that we did the mortgage credit certificate when we did the loan, and then went back in and did that, and it ended up going from owing $262 to getting a refund of $2170.
Woohoo! I love
so. I just want to make sure that, because the way it was, at least I interpreted it, that they had to owe more than what the refund was going to be.
No, so going back to that original question from Latanya on whether or not a zero needed to be there or money needed to be listed on that line. Let's say that there was only $500 listed there. the credit cannot be greater than the $500. So if they owe $500 in income taxes, and their credit was $3,000, they can utilize $500 of that $3,000 to go toward making their tax bill $0. And Sarah even had some samples there that, you know, that meant that $2,500 essentially was being left on the table. They couldn't utilize the full credit. So Sarah showed some slides on examples of how you could use that and carry that forward for the next 3 years. So in that example, they left $2,500 sitting on the table. They couldn't utilize the full credit. But what if their tax bill was $2,500 the next year? They could pull that credit forward up to 3 years to cover any future tax bills. Does that make sense?
It does. I just didn't understand how he went from owing 262 to getting a refund of 2,100.
Because essentially the tax, so his tax bill was 10,000 and he paid some taxes throughout the year through his payroll deductions.
Mm-hmm.
But he didn't pay the full 10,000. He had only paid 9,700, so he owed $300 in taxes.
Okay.
But his actual tax bill was much higher than that.
Right. So it's going back and taking.
You're getting a refund of what the taxes you overpaid.
The credit is reducing the tax bill up front. So if his tax bill was actually 10,000, then the credit is reducing that from 10,000 to 7,000.
So that's what those buckets represented.
But he paid ahead of time because it was coming out of his paycheck, basically. That's what he's getting.
His tax bill at the end of the year was only $200 and something, and that's why those buckets were created, to show folks that yes, it benefits you even if you're getting a refund, or in this case, he only owed $200 and something left after having paid $9,700 potentially.
Hey, Sarah, can I share my screen real quick? I've got a perfect visualization that might be able to help somebody know where to look.
Sure. Oh, do I need to let you?
Yeah, you need to.
I'm sorry.
All right. Uh-oh, it still says it's disabled. Oh.
Here, I think I may need to make you the host.
Oh.
To do that.
Cool. Yeah. So here you go. And Sarah and Janielle and Frank, I'll send this to you because I actually used it yesterday. Simple cut and paste from 2 different tax returns that we saw come in. The top one, just to point out, was in the instance where the borrower had 0 tax liability, right? So if you look here, line 24, because this is where you're going to check with any borrower that you have, you'll see your total tax was 0. So in that case, no tax equals no credit. I mean, there's nothing for us to use there. But then the bottom one, the borrowers did pay federal income tax. So again, we looked at line 24, and you see in this case, they paid $3,926. So we're able to use tax credit to offset that $3,926. And what was interesting in the bottom number there, in that example, the actual MCC credit for the borrower was technically higher than the $3,926, kind of what Janielle was talking about. So their credit is up to $5,000, but they only paid $3,926. So for qualifying and tax purposes here, they only get the credit for $3,926. But next year, on next year's tax return, let's say they owed more tax, then they could use up to what their MCC allows, plus go back to this year and use the balance between what the MCC was and this $3,926.
Right. Yep, exactly. And those slides Sarah provided an example of as well in the presentation. So now that knowing that, you might go back to the presentation after, because Sarah's recording it and we're going to post it. It might be helpful to look at that part of that presentation to fully understand. And it's called carry forward. You could carry forward any unused credit for up to 3 years. So do we have any more questions?
Can we have this
one.
presentation sent by email, or is it available on the TSAHC website?
So we are going to send out the recording, and I guess we haven't spoken about whether or not we want to send out the slide deck. So we can discuss that internally. We always have trouble with sending out slide decks because it leaves us feeling a little bit out of control. Should there be any changes or updates that we need to make? At least with a recording, we can take the recording down and re-record and repost. But when the slide decks start to go out and be out there, then outdated information can start to get passed around sometimes. So we lose a little bit of that control. But we will definitely be sending the recording for sure.
Okay, thank you.
Real quick for the lenders out there, to stay in touch with your customers for MCC, if you get the IRS 8396 form and make sure that you know what their mortgage certificate number is, and you know the lender, because once the loan gets sold, I think it asks who the original lender that set it up is, but that's just information that they don't have to go dig through their closing documents, and it's just another way to keep in touch.
That's a great marketing tip, Brian. I mean, that's one of the things Sarah, mentioned and I push on a regular basis. Having, and I probably didn't tell you guys this, but I started off as a realtor. So having been a realtor, having been a lender, I mean, one of our biggest struggles in that world is keeping in touch and having a reason to keep in touch with home buyers. And I think sending out a letter every January reminding folks, hey, remember that MCC I told you about that you got at loan closing? Remember to file that with your income taxes each year. And Brian, as you said, providing them a copy of the IRS form for that year, and maybe even a copy of their MCC certificate. They'll remember you from year to year. You have a reason to be in contact with them.
And if they ever reach out to you as the lender asking for a copy of their MCC, you can always go to their file in our lender portal, which is the online service that we use to make reservations and upload packages. You can go to their file in the lender portal and pull it there. There's always going to be a copy in their file.
Good question. Kind of makes things a little odd. So if a client has the MCC, and if the state of Texas at some point gets rid of the MCC program, does everyone who already has it, are they grandfathered in and continue to get that credit?
Yeah, they would be grandfathered in.
Okay.
Yeah.
Absolutely.
My question is about the Texas Heroes. If you are a foster parent, does that fall under a Texas Hero?
They should be, right? I mean, a foster parent is absolutely a hero. Unfortunately, the heroes definitions or professions that are included, we have no control over those professions. Those professions have been added throughout the years through legislation. So if you want foster parents to be added to that list, feel free to talk to your representative about getting them.
Yeah, veterans were just added in the last, I would say, 4 or 5 years. We're looking at potentially getting social workers added. We don't know for sure, but there's been legislation filed for that. So, but again, just know that the same benefits apply. So a foster parent, anyone has access to our down payment assistance and mortgage credit certificate programs. If they meet our income limits, they have access to the program, regardless.
No, I was just going to piggyback on that, LaTanya, and I would say this is, yeah, not all heroes wear capes, right? So anyone that doesn't meet that designation, the Home Sweet Texas program for down payment assistance is awesome. And, just another little tidbit that we're seeing more of with the down payment assistance side, and even the MCC with the closing costs, we're seeing more loans coming in now with down payment assistance and getting seller concessions. So there's definitely some more wiggle room in today's environment to work with your realtor partners and, negotiate for some extra seller concessions. So that way, I mean, we can get the borrower in with virtually nothing out of pocket.
And add the MCC to it. You know,
Bingo.
One of the biggest hurdles I think for folks is having to come up with an extra $500 for the MCC at loan closing, when obviously it pays for itself over time and more than pays for itself. It's a struggle and a hurdle in the beginning to come up with that extra $500. So if we're starting to see sellers concessions, John, that's great. I mean, that means one more way to help them get that MCC.
100%.
And this is where realtors can become heroes without capes.
Yes, exactly. Exactly.
Yes, Brian.
So we did have one question that I just saw come in. You know, do we run out of funds, or is there a limit to the amount of MCCs we can issue in a year? Is there a limit to the amount of DPA files we can present? And so the DPA, no. You know, the way that our funds are structured, it's a revolving fund. So the DPA never goes away, and it's just based on what the market allows us to offer every day. So we change our interest rates based on what the market is allowing us to offer that day. The MCC, there's a cap on the amount of money that we are allowed to put into the MCC pool of funds, but we've never really run out. Like, we just kind of keep the pots going, keep our allocation going every year by adding to it. So that's not really a concern.
All right.
Okay, guys, I think for time's sake, we'll probably wrap it up. I loved all the questions coming in. I love the engagement. Thank you so much for joining us. I hope the program will help you close more deals. That's why we wanted to host the training today. John, thank you always for adding a lot of value to our training. And then, you know, if you still have questions that didn't get answered, I know there were flying in there. Frank was doing his best. Just call us and email us. Email is really the fastest way for a response these days, because we have a lot of our responses automatically ready to go, and we can copy and paste and be super efficient with our email responses. So we're very quick to answer email. Obviously, always call us if you would rather chat about specific scenarios or in more detail. Always happy to chat.
I saw something in the chat, Sarah, that someone mentioned, and I think we should end on this note.
Okay.
Were you able to tell what the maximum number of participants was, you know, since we had that?
I think it ended up being around 450. Did you guys notice when it peaked?
I wrote down 425. It might have gone up a little higher than that after I wrote that down, but that's the number I wrote down.
Okay, I remember seeing 450 at some point, but so I don't know who got it close. I guess the $1 bid was the winner.
All right, everybody.
We're all over. Okay, guys, thank you all so much. Have a great day.
Yes.
Bye-bye.